Subpar investments, they can be bad luck or they can just be bad choices. We're going to talk to you today about if you are diversified and non-concentrated, then you can almost avoid having your investments go bad. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. If you have not been to our podcast before, we split it into a bunch of sections. We talk about a whole bunch of content. We then answer questions based on that content. And then we give you a little glimpse into the look of our lives, personally or professionally, and you get to learn about us a little more. Before we dive in, we're talking about investments when you think they're good, but they don't turn out that way. So without further ado, let's dive in. All right, so let's talk about first, single stocks. There's a huge reason why I don't like people picking them. Let me give you a couple of examples. I worked with BP executives during this time, the Deepwater Horizon time in 2010.
Oh, I don't know about this.
Their stock price went from $120. That rig blew up and their stock price went to $45. And that's how a lot of executives that I was working with saying, can I retire? Ever. Because guess where their investments were? BP stock. Harley Davidson stock. Oh, I'm just rattling through these. I had a conversation with a guy who runs the Harley Davidson racing team.
Oh, cool.
It was.
Yes.
He wasn't excited because the Harley Davidson stock has gone from $40 to $20 from 2020 to 2006.
These are really real stories.
They are real. He got paid in stock and some cash. And so he lost money while working his butt off. I feel bad for him.
That's like you had 2 million, you now have 1 million. Mm-hmm. That's exactly what happened.
Yep.
That would suck.
Mm-hmm. So these are when your good investments, good, turn bad.
I know how to get you fired up. Talk about buying single stock.
Let's go. You have examples of alternatives.
Oh, I do. I really do.
What are alternatives?
All right. These are like you can't buy. It's not a stock. It's like these private investments outside, or there are these are alternative investments that are, I'd say, like mutual funds most of the time. Mm-hmm. And they aren't your typical stock and bonds. They're going off, they're like hedge funds, or they're like, ooh, I'm going to be gold, or I'm going to do options. Like they're off the typical beaten path.
Okay.
That's why they're called the alternative, right? Mm-hmm. Even like I would consider crypto an alternative, right? Like
crypto bros, calm down.
Oh boy.
All
Yeah,
right.
I guess I shouldn't have said that. All right. I like data. Dave just loves my data. Mm-hmm. But it proves a point. All right. I want everyone to listen to this on alternatives because alternatives are flashy and people get excited about them. All right. Are we ready for my data?
Go for it.
All right. By January 1st, 2015, there were 1,345 alternative mutual funds promising hedge fund style diversification in a daily liquid wrapper. It sounds sexy and fancy, doesn't it?
Yeah.
Yeah, it
sounded like a sales brochure there.
Yeah, it makes you really want it, right? Okay. Well, guess how many of those still exist 10 years later, a little over?
I'm going to say 1,345 of them are still there, rocking and going strong.
No, it's 341.
Oh, geez.
I know.
Okay.
Like, if that doesn't prove a point. All right. So the other 1,000 of them or so have been liquidated or merged away. 75% mortality rate.
Oh, man.
That's an F. That is a straight fluffing F. All right. So death rates for alt funds is higher the further back you look. This was just 10 years.
So they don't last long.
No. I mean, sure, there are the few that outperform. I am not going to say that there are not. But if you look at these numbers, why the fluffing bother?
Yeah.
Fine. If you want to do it and you want to put it in your rodeo account, which I will talk about later, 5%, maybe 10.
All right. So let's jump into it. Why these, because they're illiquid, these investments, and we'll kind of dive into that. But why are they so attractive? Let me give you a story. Imagine if I came to you and I said, do you know that I'm building a hotel? I have a chain of hotels.
Oh, you do?
I do.
Oh,
I
okay.
sell them for top dollar and I can build them for dirt cheap. So that means that your returns are going to be chef's kiss.
Oh, I want to buy already.
I don't offer it to everybody.
Oh, yeah, no, you don't.
Select amount of people.
Oh, no.
Typically people who got money. I'm going to keep your money for a while and you can't get access to it just because I got to build these hotels.
I mean, real estate is illiquid. I get that.
You'll get your money back.
Yeah. Okay.
Yeah.
I'll get my money back.
There may be some tax advantages. Can't promise that. Maybe.
Yeah.
We'll see.
Okay. There probably is now with OPA, the tax bill. But yes, okay, let's say there's tax advantages. All right. Yeah.
Can I have your money?
I mean, yeah. I mean, like.
So that's what it sounds like when someone is offering you an alternative investment. Your money's going to get locked up. Dubious how it's invested. It's going to sound sexy. It's going to sound flashy. Your returns are going to be high. There's going to be some tax advantages. Maybe now, maybe later in the future.
And they give you spreadsheets on how the returns are going to perform.
And will they understand how it works? The regular consumer? Probably not. They'll understand how it works on the forefront, but there's not going to be a great amount of understanding of exactly how this investment works. Do they work? Your data said, chances are no.
You laugh at me. I don't know why. It must be that I get more of the ones on the I get the aggressive investors. They play.
Yeah. We
play in with parameters, but I track these. Okay. One of my clients is in this oil and gas investment that promised, the depletion. I mean, it's all over social media right now. You put $100,000 in, you're going to get an $80,000 tax deduction. Well, that already sounds sexy, doesn't it?
Right.
So with my client, I mean, we went in eyes wide open. We said, let's only put this much in to test it. And they promised that we were going to get, income every month off of the drilling. We are, but is it the amount of money that they said we were going to get every month? No, it's not.
Okay.
And, we have an agreement, me and my client. Again, we negotiate. And I was like, we're not putting any more in until we see that this actually plays out how they said.
Yeah.
I mean, this is typical. And I feel like some win, some don't. I don't think many investors, which scares me, but I mean, they give pro formas for these illiquid investments. And you can analyze the data, you can analyze the spreadsheet. I don't know if they go back to it and say, did this actually happen? They're just so happy that, I got
something.
I got my money back and I made like 30%. Okay. But then how long was it locked up?
Yeah.
And so how much did you really make? You didn't make 30%. What did you make on an annual basis? And then you have to pay taxes normally when it comes out, unless it's, one of those real estate ones that you can 1031. So you also have tax drag. Like you have to pay taxes on that. So there's this big difference that, when I really look at that, like, okay, yes, they're sexy. Yes, they're fun. But also from the tax efficiency, it really ruins the returns.
Sure. I think people go into these, and if I ask them, did you seek this investment out and really try and understand it? I don't think I've ever had anyone say yes. They've either said it was sold to me or someone suggested it'd be a great idea who was a friend of mine. This isn't something that's, like you said, it's not proven. And so when people are saying, okay, this was fine, can I get my money back? And they're met with that blank stare of, sure, the redemption window is 9 months from now. You can get it back then.
Well, I'm going through this with a client. One of my clients came to me with an alt, and he listens to this podcast. So hi. And, he went in under a previous advisor, and eyes wide open. This is his rodeo money. We're not even including it in the plan, so no problem. But he wants to get out of it now. Well, I had to figure out how to get out of these because I don't buy these for my clients. And so, we have to look up the SEC filings. I have to find out when the tender offer is. And it was so weird. So a tender offer is basically when you can say, I want my money back. Okay. So one, I don't know if the average person would know to go to the SEC filings.
No.
And then we had to submit all this paperwork. Schwab also had to send a signature to this fund company. And what was so bizarre is my client told me that they wanted to try to get out of it like 4 or 5 days before the tender offer closed. So I was like, whoa, this is really close to the window. I have no idea how long this paperwork takes, but we're going to try. Well, I mean, we're still in this right now. This was about a month ago. And we missed the window. Schwab didn't get the signature to the fund company in time. And so they're like, oh, and then they're like, we'll see if we'll make you an exception. Then they say, we're not making you an exception. Then the client gets a letter and says, we are going to give you the exception. Right now we're on it. We're like, Schwab's trying to figure out which one is it. Are they liquidating it? Are they not? Like, I mean, it feels a little bit like the Wild Wild West. And like, you know, I know we'll get it. It is a bigger fund company, but again, like, if you want your money, I don't like this feeling.
No, you've got every ETF investor listening and watching this going, what? I just sold my investment yesterday and now I have the cash.
Yeah, like
what are you talking about?
Yeah. I mean, again, this client knows, you know, no, we went into this eyes wide open, but I don't think playing it out, people really understand about these alternatives. Like, it is not liquid. And that's, don't even go to the real estate ones. They have to sell to give you your money. So you want it, you're not getting it.
Yeah, I think a lot of people go into these without a plan and without the exit strategy. Like, if you're trying to understand, okay, this is going to get me a lot of money and it's going to do it in a certain time frame, which this person promised me, that's not an exit strategy. Like, when you're investing, you should have the exit in mind. Whether that's a certain goal, a certain dollar amount, a certain target, you have to understand, when is this run its course? With these type of investments, you don't control that. And even if you miss the tender window, you may have to wait another year. And are you going to remind yourself the next year? Who's doing this? Like, who is going to make sure that you actually hit the window next time? And sometimes these just drag on and people just keep these investments because they forget to redeem them. And it's not on the company to help you redeem it. They want your money and they're going to keep it.
Yes. I also think we're going to go dark a little bit, but it goes back to human behavior. Greed. That's why people want these. And it's, oh my gosh, I can double my money faster than my friends over here, or I can get ahead faster. Like this, the quick rich scheme, right? It's like, why do you think the lottery is so popular? Right? Like, just look at that. And, you know, I understand investment behavior, and sometimes we do want to take the shot. I'm not against that. Like, if you really believe in it and it keeps you energized with your money, like, all right, well, if it's between my client's going to, buy $100,000 Birkin bag, or they want to buy a $100,000 alternative, like, who's to judge them, right? Like, if they want to take that shot, go for it, because sometimes the swings do win. They do. But it is not. What did I give an example to the Hermes Birkin? And why did I do that? Because it's money they don't need. Yeah. It's their fun money. Like, I don't care. Take 5 or 10%. Go play. Because what I've actually found with my clients that do have that kind of behavior is they want to play a little bit. Is if I let them play in this sandbox and I get the whole grass field, well, good.
Sure.
Did you like that example? I don't know where I came up with the sandbox and the field.
It was like, sure.
They get the sandbox and I get the whole playground.
Keep going.
Okay. Are these all good? All right.
I've never heard that one before.
I know, I'm making it up. I have another story that I want to share.
Go for it.
Because, me and illiquid investments seem to follow me. All right. So I speak to a woman. I'm very, very lucky. She literally manages some of the wealthiest individuals in the U.S., where she's like the bill payer. It's like that. They don't pay their bills.
Oh, she's like on staff with the rich people to like manage their money.
All over. Yeah. Like she oversees it.
Okay.
Like, very, very intelligent, but that's like her job. She was sharing with me. So she has 2 different clients, and they have both invested in this illiquid private real estate company. One loaned millions of dollars to the private real estate company and is earning a certain % of interest, and they were supposed to be paid back a year ago. Okay? I mean, you're giving that face because this is not unusual. Right? And every time this client, the one that has the loan, calls to be like, well, when am I going to get my money back? You're late. Her other client gets a call to ask if they want to invest more money.
Oh, gross.
This is a true story, okay? Because I was sharing with her, like, just talking to her about alternatives and like what she sees with her clientele. Yeah. And I share with her and she goes, I was like, I would actually tell your clients, like, because I'm worried. And she's like, I know, but I don't want to break confidentiality. I'm like, I get it. Don't share names. Don't share any. But if I was a client, I'd want to know.
It sounds like a Ponzi scheme right there.
Yes. Like, what are you going to regret more? Your client sues you for sharing the story, or they go put more money and lose it more?
Yeah.
Like, I mean, I think you can do this in a way without giving confidential information, right? And I mean, it was just real. It's just like, this stuff really happens even at the ultra, ultra high net worth level, because it's, ooh, sexy returns. They sold you the website. I looked at the website of this company. I'm like, dang. I mean, it's like the construction is all pretty. You got the hard hats and they're building these big buildings and you're like, whoa, I want that.
Yeah.
Right? I'm just saying.
Oh, that's sad that happens and people just get baited and switched on all of it.
Well, but you don't know. They're not publicly filing. They don't have to.
Right.
A study was done in 2019 on active managers. Let me define what active managers are. These are people that are trying to outperform the stock market. They are trying to pick the winners. Okay? They're trying to pick the Nvidias, the Apples. Besides a typical underperformance, so in case you don't know, most active managers underperform. The stock market is efficient. All right? They're great at buying, but they're horrible at selling. They would have been better off selling at random. I mean, that's hysterical. Like, they give too much attention on buying rather than selling.
Kind of plays to the ego, doesn't it?
I mean, I get it. Losing sucks.
Yeah.
Okay, here's Heather on her soapbox for a second, but there's a lot of people saying how they've made money. Do you think the same amount of people are telling you how they lost money?
That's a humble social media account right there.
Yeah. Do you think that it's equal? Like, hey, I over-leveraged Bitcoin and I went on margin too much and then I had to take a HELOC on my house. Do you think someone's going to tell these stories?
No.
Yeah, no. And I get it. I just don't think that people really understand that. They're just hearing about people winning, and some of that is 120% luck.
Yes. They were in the right fund at the right time.
Yes. Yes.
So we've kind of bashed on these quite a bit for good reason. I do think there's a time and a place for it. So I think we do need to talk about how people can use these, but safely going forward.
Oh, I have one. One of my clients wanted to buy a stock that they really believe in. I'm fine with it. I made him give me the exact dollar per share that we get out at. I said, I will buy it if you tell me when we exit.
So you gave him the exit before you even started?
I wouldn't buy it until he told me at what price we would sell.
For a lot of people, and a lot of people don't do this, it's either use money that you can lose, which you touched on, or I think it's you have to have it as part of your portfolio, which if it goes up or down, doesn't really mean much to you. So for a lot of people, the 10% trigger is there. I like even less. I'm at a 5% because there's a chance you're not going to get your money back on time or at all, and the income's not going to be there, and so many different things can happen. I want it to be a tiny little blip on your portfolio. And if it's a winner, fantastic. That's a blip as well. It doesn't even really matter. Some people, this is hard to talk about, include these assets in their retirement income plan.
Oh.
And you know how we are with our retirement income plans. We want them to be perfect.
With their magic. They're our magic.
And so if people are including these saying, okay, so this is going to kick off, a 5% dividend every year. It's going to be in June, October. No, it's not. No. and if they're relying on it to happen and that's going to fund those month expenses, I just hang my head at that point. I'm like, you're really... Like, if it does, that's fantastic, and your income plan is working to a T. If it doesn't, what is the backup? Because you have to have one, because these things just don't act like they are sold.
Those are my clients' rodeo accounts. They're their play counts. We do not count it in the end. It is not, it's not included.
Rodeo account.
Rodeo play, like rodeo, like you're on the horse and you're getting thrown. I mean, that's what it reminds me of.
I haven't heard of the rodeo account before.
Barry
Ritholtz.
Yes, in his book, he talks about it. And it's an amazing book that I'm going to talk about on one of our podcast episodes that I read. It's it's all about how not to invest. I was like, this is fantastic. He just goes, his stories are the best stories. I mean, you take our stories. I mean, he's been on Wall Street for 30 years. It is hysterical. I can't wait to share with our listeners.
Cool.
Yeah. Okay.
All right. So if you haven't guessed it already, if you're going to invest in illiquid investments, make sure it's money you can lose. All right. You got a bow, right?
Knowing behavior and history, you're going to want to deviate. Something shiny is going to come across your desk at some point, your life. Dave did it. 5 to 10% max. If you're retired, it is not included in your retirement portfolio. Dun, da, da.
Perfect bow.
And when I say 5 to 10% max, that is of your investment portfolio.
If this is your first time here, sit back, relax. You got nothing else to do. If you have come back and this is not your first episode anymore, we need something from you. It's a like, follow, subscribe, send it to your mom. Send us cash. Was that too much? No.
Send us cash.
We love sharing this message with as many people as we can. And so that simple action just by you, and it's free, really helps us. So we appreciate it. Thank you. We're moving into the question segment of our podcast. It is called, What Would You Do?
My advisor is suggesting I use a non-traded REIT, real estate investment trust, to hold real estate in my portfolio. Is this wise, and should I do it? Wait, okay, I'm going to let you answer. But what I'm the most surprised about this is that the advisor is suggesting a non-traded REIT.
I've worked with one of these advisors.
Oh, I can't wait to hear about this. Oh, you've worked with them?
Yeah.
What do you mean, like pre-days before your company?
Yeah, they were one of my supervisors.
Okay. Oh, I can't wait. Wait, now we need the backstory.
All right, little education. Non-traded REIT. Buying real estate. It's what we talked about. It's non-traded, means you can't buy it and sell it quickly. It's not liquid. The answer is no. I don't think you should buy a non-traded REIT for all the reasons we just talked about. Because there are publicly traded REITs, which you can buy and sell the next day.
Well, but the untraded REIT's going to promise better returns.
Is it going to make it though?
So what? Tell me, why did this advisor, you're like, I got to know, why the fluff were they recommending it?
For all the reasons that we stated before. Better returns, tax diversification, all of this. And I just sat back and I'm like, I can't do anything here. I'm a junior. And people wanted to sell it and they couldn't. So
you saw it. How did it end up performing?
No idea. Probably underperformed. If it's a non-traded REIT, don't buy it. Buy the publicly traded REITs. And you can buy REIT indexes. So you're not even participating in particular types of real estate. It's just tracking real estate as an index. You can buy it. You can sell it. It's simple. Less hassle.
So such less hassle. Sometimes simplicity really wins. Mm-hmm. Like actually most of the time. Like over the long run, why does index investing win over the long run?
All right, question number 2. I lost 40% of my portfolio through selecting bad investments. I cashed everything out.
No.
How do I get back into investing when I have this fear of losing 40% again?
I'd start with the why. Why do you need to get back into investing? Mm-hmm. You got to get their energy back, right? I mean, they're going to have some PTSD from losing 40% and selling and explaining how this time will be different. And I know that is dangerous words, but it's not dangerous if you're doing something different. Sure. So they're not going to be investing in bad investments. Mm-hmm. So they're going to invest in hopefully index funds, good portfolio. Hopefully they have someone hold them accountable and stick to the plan so they don't sell at the wrong time and they don't buy the bad investments. And if they want to go buy some bad investments, they keep them in their little sandbox.
A lot of education goes a long way here.
Yeah. Yeah. I mean, look, I'd be lying if I said I didn't have clients, not in this exact situation, but have made really bad investment mistakes and have PTSD.
Yeah.
I mean, again, I guess that's like really why I light up at the end of the day is it's amazing to get them on the other side and them to see like how it goes when it goes right. Mm-hmm. And like, okay, I'm not in this alone. I'm not going to do the same thing again. And they feel good about their money again.
Yeah. Good.
Yeah. In my bond investments, I use individual bonds. One of them went bankrupt and I lost all of the money in that holding. How do I avoid doing this again with bonds?
This is actually not unheard of.
Bonds going bankrupt? Mm-hmm. Or the companies are going bankrupt, I guess. It's like a corporate bond or?
Yeah, or a municipal bond where you're investing in something. But how do you avoid this? All right, so if you're using individual bonds and you're not well educated in using them, use bond funds. Typically, you can use index or active bond funds, whichever approach you like.
It's so much more diversified.
It's my answer to the question. It's just a lot more diversified.
I just want to agree with you.
It's going to take the selection option off your plate. It's going to take just monitoring off your plate. It's just going to do everything you want to. If you still want to use individual bonds, some people use it for their retirement portfolio and triggering cash at certain points. Use highly rated bonds. Like these are AAA, as high as you can get if they're corporate. If you're going municipal, you want to choose stuff that is the top of the barrel. Like you don't want to be dipping anywhere below just to chase some higher interest rates. It doesn't work. Let's get into the weeds for like 20 seconds.
Okay.
When you're selecting bonds, they can be general obligation bonds or they can be revenue bonds.
Oh, dear gosh.
All right.
I'm sorry, listeners. I'm sorry right now. Where are you taking this, Dave? Where are you going?
All right, layman's terms. If you buy a bond that's a general obligation bond that is backed by taxes that are paid by everybody who lives in that municipality of that bond.
You're going in like, okay.
I'm going top level.
Okay.
So it's backed by everyone paying in their money at a certain period of time. It's almost guaranteed. If you buy a revenue bond, that is like buying something that is not guaranteed yet, but some revenue is going to come in at some point that's funding that project or is a kickoff of that project.
Sounds so much more risky.
And it might not be there. So most of the time it's more yield, it's more return, but there's a lot more risk. Chances are that's what you found out when you went bankrupt in one of your bonds. So don't do that. Okay, going into the last section of our podcast, this is called Highlights. This is where you learn about me and Heather, whether you want to or not. Sit back. I'm going to stay on topic. My highlight is all about alternative investments and how I screwed up. Yeah.
You're openly sharing this already.
Vulnerable, yeah. And you know what drove it? Greed. There was a Thanksgiving probably about 6 years ago that Bitcoin was really volatile. So I bought Bitcoin. It went up 25%. I freaked out and sold it and made some money. Felt amazing.
Okay.
Then Bitcoin ETFs came out. I took all of my Roth IRA.
No, you didn't.
It wasn't a big Roth IRA. But I took all of that Roth IRA and I invested it into the Bitcoin ETF because Bitcoin ETFs are going to track Bitcoin, and it was going up. Didn't go up. Went down.
Why?
Because Bitcoin decided to freak out.
Oh.
Yeah.
But it did track Bitcoin.
Kind of. This is when they just came out.
Oh, so
they were saying, yeah, it's going to track it. It's going to be fine.
Oh, tracking error.
It was a mixture of the tracking error. It was a mixture of Bitcoin just being fluctuating all over the place and of the spot price on that day. Didn't work out because I was greedy. I lost half of my investment. And then I sold the Bitcoin ETF and went right back into index funds like I should have been in the first place. So if you've listened to nothing of this episode, listen to me. Don't do alternative investments.
This is when the advisor doesn't have an advisor watching over watching over you. This is like,
Yeah.
It
was a small account, but yeah, I shouldn't have done it.
So redid the house, as you know.
Mm-hmm.
We're still not completely done. I still have one more bill from the interior designer, working through that right now.
Okay.
But pretty much done. And I was like, well, I've been talking about hosting. If I don't host in this house, what the fluff am I doing?
The kitchen is for the four of you.
Yeah. So I did the thing. I had 4 couples over with kids.
All at once?
All at once.
Wow.
I know. I just dived in. And, well, I don't like to exclude people. So it's kind of like if you invite this family, then you got to invite this family.
Mm-hmm.
So there were 20 of us in my house. I ordered pizza. I had everyone bring something. It went great.
Good.
I did it.
I was waiting for the pin to drop there. I'm like, what happened?
Well, there is a little funny story if we have time. I got a text next day. It goes, you might want to tell so-and-so's, well, can you ask Sophia, that's my daughter, I'll leave out son's name, showing his private parts in your closet to the girls? So I asked my daughter, It's true. And
Wow.
at 5. And I'm like at my house when I'm hosting. And now I have to tell the mom. But like, I'm not mad. I chatted this and realized this is normal to do at this age. But why?
This is your first time hosting.
Yeah.
And this goes down.
Uh-huh.
Wow. Way to bless that new kitchen. All right. That is the end of our podcast. Thank you for listening to this episode of Playbook of the Wealthy. If you want to follow us on the podcast format, we're everywhere you can find us on the podcast. Go take a look. If you want to watch us on video, because who doesn't? We are everywhere. We're YouTube, Spotify, LinkedIn, Instagram. If you want to send us a question, I'll get to that in a second. You got to go to our website first. It is playbookotw.com. From there, you can send us a question, or you can send it to our email, which is hello@playbookotw.com. And we'll see you next time.
Toodles. Dave, what's the temperature supposed to be on Friday?
-31 wind chill.
Do you know that I have never experienced that in my life?
You're about to now.
You are picking me up, right?
You're walking to the studio. Will she make it? Find out next time on Playbook of the Wealth.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.